Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and joining me on today's show, I'm delighted to say I have Nick Train of Finsbury Growth and Income. Nick, welcome to the show.
Great to be here, Simon. Thank you very much. And I hope we do have something interesting that will help your viewers actually make some money.
Well, let's start with how you invest. So obviously, you're a very well-known investor in the UK. You've been doing this job for quite some time. Could you explain to our viewers, what's your investing philosophy? How do you like to invest, and what do you look for in a good company?
Yeah, just to put some numbers on that, it is pretty much a quarter of a century that I've been responsible for Finsbury Growth and Income Trust, which I'm quite proud of. That's quite a lot of longevity there. And I'm also proud that the approach to running that portfolio is absolutely the same today as it was a quarter of a century ago. So definitely have stuck to a clear set of principles. In fact, some of the holdings that we first initiated in nearly a quarter of a century ago are still key positions in Finsbury's portfolio. And I guess that there's a clue in what I've just said to how we, as they say, approach the investment challenge. I was exposed to, as so many were, Warren Buffett and Charlie Munger at an impressionable age and an impressionable point of my career. And the lesson that I took from their incredible success was that a way to do this, there are lots of ways to conceptually make money out of stock markets, but a way to do this is to construct very concentrated portfolios built around shares in companies that you've got good reason to believe are high quality. That's a slippery terminology, but excellent businesses, where you can understand why they might remain excellent businesses over long periods of time, and then to sit very tight indeed. And, when I look at Finsbury's performance, we've had some ups and downs. That's had a tougher time actually over the last 2 or 3 years. But when I look at where the returns have been generated in Finsbury Growth and Income Trust, it's been really long-term ownership, 10 years, 15 years, 20 years in some cases, of businesses like the ones I've just outlined to you. Clearly exceptional businesses. And I think this is really important actually, not just by the standards of the UK. That's interesting enough. But can you find companies, I would say it is a UK equity vehicle, but can you find companies listed on London that are evidently among the best in the world at what they do? And that's it, basically.
And you mentioned there, and for a very long period of time, Finsbury Growth and Income was outperforming, its benchmark. It was outperforming the stock market. It was outperforming rival investment trusts. And it's had a harder time over recent years. And running a concentrated portfolio, presumably when things are going against you, makes things a bit tougher. How do you find it in that scenario where, as you've said, you try to stick to what you've laid out as the plan and how the trust is going to invest, but you have people saying, oh, well, you should be changing that. You shouldn't be doing it like that. Is that difficult as a fund manager to deal with, or do you just have to plough on ahead and stick to what you said you were going to do?
Listen, I can't speak for all market participants, but I'm with George Soros, who said that I found running Quantum, that was the name of the hedge fund, wasn't it? I found that very painful. Either I was performing very well, in which case I was terrified that my golden touch was about to desert me, or I was doing badly and I just felt wretched, on behalf of my clients. And, without wanting to, try and earn anybody's sympathy or anything, but yeah, it is no fun underperforming. And it really, really behoves you in those circumstances to behave in a disciplined way. And I hope that we, the team working with me, that we have done that. I think for sure over the last 3 or 4 years, what's become apparent to me, perhaps belatedly, but what's become more apparent to me has been that changes in technology has resulted in the emergence of industries, maybe more companies. It is a result in the emergence of companies that meet those long-standing Buffett criteria of greatness. Maybe the great industries, the great businesses of the 20th century aren't necessarily the same as we get deeper into the third decade of the 21st century. And although everything's quite measured in what we do, there have been no radical changes. But if you look at the shape of Finsbury's portfolio over the last 4 or 5 years, there definitely has been a shift, in particular towards what we were talking about earlier, Simon, these London-listed data analytics software companies that, seem to us to have an extraordinary opportunity ahead of them, and arguably a really intriguing valuation opportunity as well. So that's a really long answer to your question. Was that helpful?
No, I think what you're saying there is you've got these high quality businesses with longevity, but it's which of those can take advantage of the technology, which of those can, move with the times, but not move with the times, move ahead of the times. So you mentioned the data element, and AI has obviously been the main thing on lots of investors' minds for quite some time. There's been a huge amount of focus on the Magnificent Seven, for example, huge amount of focus on chip makers, but maybe less focus on the companies that own vast amounts of high quality data. And I think one of those in your portfolio that you talked about before is RELX, isn't it? What is the attraction when you look at RELX and look forwards? What is it that you see there as being so valuable?
Well, we've owned RELX for at least 2 decades, and I hear what you're saying about all the focus is on the chip companies or the big storage companies. Actually, RELX has been a pretty spectacular investment over the last couple of decades, maybe a bit below the radar. Actually, I think it's just worth saying this, just apart from anything else, to make people not completely give up hope in the UK stock market. But so let me just share this. Back in 2000, RELX was the 68th biggest company in the FTSE 100. So FTSE 100 company, but clearly in the bottom half. Today, RELX is, I think, the 6th biggest company in the FTSE 100. So its shares have done really well. And because its shares have done so well, it's become a much, much more important company within the UK stock market. And I don't know, let's just say this was just the beginning for RELX, and the next 20 years was going to be as rewarding as the last 20 years. Actually, do you know what? I think there's a good case to argue that. Then RELX is of a size now when it can really begin to impact the return of the total UK stock market. But you're right. Even back in 2000, arguably since the foundation of the Elsevier publishing, scientific publishing house, which was it 1670 or something? You're looking at centuries, arguably, of heritage within Reed Elsevier. For many, many decades, scientists, scientific researchers, lawyers, people working in the risk industries, the insurance industries, they've not been able to do their jobs effectively without access to RELX's proprietary data. And that's driven the success of the company over much of the last 2 decades. What is so, well, I think compelling is that as the technology develops, if the company can stay on top of that technology and exploit it, there's just more and more value that it can derive from its data that nobody else owns. So my favorite, actually it's not trivia, but my favorite recent statistic about RELX, they've just been telling, I think as a sort of a commercial for their own products, they've been saying that early adopters of the RELX legal co-pilot, helping lawyers run their businesses more efficiently, early adopters have been receiving a, wait for it, 280% return on their investment. In other words, these tools that they've been able to provide lawyers have radically improved the efficiency and the workflows of the lawyers. That's helped drive RELX's growth recently. The big prize, Simon, the big prize, and I almost say this, and I'm serious, the big prize for humanity is if RELX can introduce similar tools to the scientific community and the research community, the drug research community, to help make those processes more efficient. Because if they can do that, and they're working on it, that's not only going to keep driving RELX's profits and share price, it's also going to be good news for the planet. So yeah, RELX, it's a very important company that those of us who you might say have the misfortune to be UK equity managers, we're lucky, I think, that a company of that caliber is such an important part of the London stock market.
And does that same proprietary high quality data sort of case for holding apply as well to other companies that are more consumer focused, that are in the portfolio, Rightmove, for example, or Experian?
Oh, absolutely. There's a clear, we've all learned lessons from NASDAQ. So platform businesses that accrue more views or have more members on their platform, not only does that lead to improved short-term profits, it means that they're constantly accumulating data that's unavailable to owners of smaller, less successful platform businesses. And you can see a Rightmove or an Experian predicting an acceleration in their revenue growth right now, 25, 26, as a result of their privileged, advantaged sets of data that none of their competitors can access. Experian has persuaded 200 million private individuals around the world to voluntarily sign up to the Experian credit business, sharing all of their personal financial data with Experian only in return for services that Experian can offer them. That's an extraordinary asset. Something like 1 in 3 of every adults in the United States has voluntarily signed up to that Experian service. I'm talking about Experian like this because the shares have had a move today, and it's just become, today it's the biggest holding in Finsbury, which I'm excited by. But yeah, that data theme, that is a rich theme globally, but it's, despite what people think about the UK stock market, it is a theme that can be explored within the UK stock market itself. We initiated a holding late last year in a company called Clarkson. Do you know Clarkson?
Shipping broker?
It is. Clarkson is by a considerable margin, the world's biggest shipbroker. Now, that's already of some interest, but what's really interesting to us is that Clarkson aggregates, curates, and creates value from more data on the sort of maritime fleet worldwide than any other entity. And it's really exciting to see how the company is creating almost a brand new revenue stream from that privileged access that it has to data. There is a truly world-class UK company that happens to have outperformed the NASDAQ over the last 20 years, but totally under the radar in a stock market that certainly global asset allocators barely care about, with clearly a secular opportunity to use technology to create new value. I can get quite excited about the sort of opportunities that we find in the UK stock market. Absolutely.
I think it means patience, first of all, not getting carried away with sentiment and noise and trying to focus on what really matters in the long term. And I think it means steering clear of hot stories and focusing on fundamentals. What is it that's really driving in the long term the revenue growth, the profit growth, the dividend growth of a company? So it's no one thing, but that kind of patience with a long-term outlook, being honest with yourself about what's really going to drive profits and dividends. That's the foundation, I think, of long-term investing.
You've got two very famous holdings in the portfolio that are more concerned with actually making things and getting them out the door, that have struggled a bit in recent years. Burberry and Diageo, both of them have outlined, plans to get themselves back on track, and getting, varying degrees of traction with that. What are the attractions of continuing to hold both Burberry and Diageo?
Well, a trite answer is to note that Burberry's share price has significantly more than doubled over the last 12 months. Now, admittedly, from a horrendous low, which was no doubt about a crisis for the company's strategy. But, I mean, thank God we didn't sell at the bottom. And I think what's happened with Burberry over the last 6 months, when the shares have rallied strongly, is that once the trading has stopped getting worse, investors have kind of said to themselves, should I carry on selling an asset like Burberry, which, when you get down to it, I don't think many people would disagree with this. I mean, Burberry is a unique global brand. Whether it's pure luxury or mass luxury, I don't know that it matters that much, but it is an important global brand. I sometimes think that people in the UK, we disparage ourselves. So, we don't recognise success. I'm not denying that Burberry's had a tough 18 months, but when that company first listed back in 2002, its annual sales were £500 million a year. Last year, which was a very, very difficult year for the company, its annual sales were £2.5 billion. So over the 20 plus years, this company has quintupled its sales and demonstrated that it can offer investors a participation in the long-term growth of luxury spend, which is in a cyclical downturn at the moment, but which will come back. On Diageo, I suppose I would argue something similar. That, I mean, the way I think about it, maybe it's too simplistic. I don't know if it's too simplistic, but certainly, I mean, forget the 20th century. I mean, the brands did very well in the 20th century, but even in the 21st century, Diageo has outperformed the Nasdaq so far in the 21st century. Since January the 1st, 2000, you would have done better buying shares in Diageo than you would have done holding Nasdaq. Not a lot of people know that. Now, it's not true. It's really not true of the last 5 years. But, you know, you've got to ask, why was Diageo such a successful investment for 23 out of the last 25 years? And it's because when people around the world feel wealthier, they do two things. They drink less alcohol. That's definitely a fact. People curtail their boozing when they get wealthier. The obverse of that, though, is that they increase the caliber, the quality of the beverage that they choose to consume when they do consume alcohol. And when you look at the history of Diageo over the last 25 years, it's been about the growth of their premium brands. And again, charge me with being unimaginative. I don't know, but owning, if you invest in Diageo, you have eternal ownership of Johnny Walker, of Don Julio Tequila, of Guinness, of Tanqueray. You've got this important 1/3 ownership of Hennessy Cognac, of Veuve Clicquot, of Krug Champagne. You've got access to this incredible collection of iconic global brands that have grown when the world's economy has grown and people have felt wealthier. The fall in the share price is a once in a decade, once in a generation opportunity to own a truly exceptional global business with just outstanding brands. I've got to say that, haven't I? So that's what I'm going to say.
And do you look at those brands and then look at the success of, for example, the non-alcoholic Guinness and say, well, actually, there's another opportunity here in that they may not want to roll out non-alcoholic versions of all of those brands, but there's certainly a big long list that you can start ticking off the numbers.
It wouldn't be the reason to own the shares, but at the margin, yes, the success of some of those non-alcoholic variants at the margin helps, but it only helps if it grows the category or grows the brand. And I think in the case of Guinness, there's clear evidence that the 0.0 has grown the overall brand offering. But if it's just cannibalizing, I think that's less interesting. You know, people, and I get this, people are concerned that there's a cyclical downturn, there's no question, and wallets are being pinched. I don't mean stolen, I mean constrained. And that has hurt Diageo's business performance over the last couple of years. But I do think that those of us who are still invested in Diageo can say, look at Guinness. That has been growing at double digits for the last 3 or 4 years, driven by young people finding that brand and saying, wow, this has got heritage, it's got a different taste, it says something about itself and about me if I drink it. The tequila boom in the United States, which continues pretty much unabated, I mean, that's been a huge benefit to Diageo. And if tequila were to become as successful outside the United States as it's proven to be in the United States, there is multi-years, if not multi-decades of growth to come from the owner of the world's best tequila brands, which is arguably Diageo.
And just a quick final question before we have to wrap up, but obviously you're an investor who invests, you know, by company. You look at those individual companies, but looking at the UK as a whole, looking at the investor appetite for the type of companies that you hold for the FTSE 100, for the broader UK market, it hasn't been great in recent years. Do you think that is changing, has already changed? Do you think genuinely the world is looking at UK companies and going, okay, well, actually, maybe I might be a bit more interested in those now?
I do, but I think that it's step by step and incremental. And if there is a wand to wave to suddenly make the UK equity market look more attractive to global asset allocators, I don't know what that wand is. But I really do. Can I have I got time for an anecdote?
Yes, of course.
An investment that's done actually quite well for us over the last 4 or 5 years is Sage, the last man standing amongst that first generation of British technology companies, software business, with a very successful business. Indeed, its biggest business in the United States. Sage is competing and winning in the United States. It's so exciting. About 5 years ago, Sage took a decision to cut its profit margins and reinvest those savings into research and development and more marketing of its services. At the same time, Sage deliberately slowed down the rate of its dividend growth. And at the time, I remember investors saying, oh, the company's committing suicide, it's the only reason people owned it was for the dividend growth, and profits are down because they've deliberately taken this hit to the profit margins. But here we are, the shares have doubled since they did that. And I hope that is a lesson to boards of UK companies and it's a lesson that's so obvious in NASDAQ, that investing rationally for long-term growth is rewarded by investors. What's not rewarded is paying ever-increasing dividends that aren't being earned out of earnings growth and starving the business for capital. So there was a 30-year period when it seemed that all you needed to do to make money in the UK was to invest in high dividend yielding value shares where the companies paid out almost all their earnings as dividends. That's done. That's over. The question is there a cohort of more growth-oriented companies coming through in the UK that are world-class and have the potential to drive the index? And I think one can see the outline of that happening. And I hope we own enough of them in Finsbury to get that NAV moving again.
Nick, thank you very much.
Simon, thank you.
And thank you very much for watching. Join us next time on The Investing Show. Goodbye.